G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. We're bringing the dream team back together. So we've got the brokers from our team answering some Q&As, but today we are also taking on a bit of a different flavour, which is an end of financial year reflection. G'day Damien and Bernie, how are we both doing?
G'day listeners, g'day Aaron.
Hi everyone.
So tell me, this is a Bernadette fashion. This is one of the traditions that we have in our circle, which is when we get to the end of the calendar year, we do a reflection and go, what's your one word to sum up the year? So I'm going to throw it back to you guys to say, what is your one word to sum up this financial year?
The only word that came to mind for me, ACD, was roller coaster.
Okay.
Mm-hmm.
Tell us more.
Mm-hmm.
Is this a personal thing or is this a professional thing?
Well, is it a professional or personal?
You tell me. You're the one answering it.
It's, I think, the first half of the year, so July to December, from a professional point of view, and for a lot of us as investors, was still very uncertain. We didn't know where rates were going. There was still a lot of hesitancy in the market, people sitting back, waiting and watching. And then there was like a light switch that flicked in January, and it's been, so maybe my words are not roller coaster, maybe it's duality or a tale of two cities, because this first half of financial year from July to December, it was quiet. It wasn't as busy as normally is for us, and January to now, we've been busy, very busy. A lot of active investors, people who have been sitting back for the last 18 months, itchy, wanting to buy, uncertain what the market was doing. Now rates have stabilized and they are hungry and they're ready to move, and which has been really exciting to see.
Cool. Exciting, but I know you've been burning the candle at both ends, so I'm sure you can be happy to see some type of normality in the property market as well. Good. Damo?
Yeah, look, what Bernadette said was pretty much what I was going to say, word for word. I was going to say mixed, because it was such a slow start to the year, and then, something switched in Christmas time after Christmas, and we just saw, our settlement numbers doubled month on month, right? They just continued to go up. So still a lot of activity now. Tale of two halves. That's what I was literally going to say. It is, it's just such a contrast between July to December and then December to June. Yeah. Such a contrast.
Yeah. Spot on. Exactly what you guys are thinking. My word was split. Exactly that. Like, I feel like the player at the end of the football match, tale of two halves. And like the first half was easy going. But I think for us, the uncertainty the second half of last year, so the first half of this financial year, was people waiting and seeing rates, what's going to do, for example. And it literally got to the start of this year, the first week back for us, and it was just on. It was, inquiries were flying in. People weren't sitting down, people weren't sitting on their hands anymore. They were like, I'm going to actively buy. And it has been, I don't know if I think sometimes we also reflect on ourselves going, are we giving clients that confidence? So go and buy that property and it's part of us, or I don't know what other brokerages are going through. But for us, that has certainly been our feel, which is the first half was a little bit, for us, a little bit slower going, and the second half of the year just hit its straps.
Yeah, well, I remember having a conversation with you, Aaron, in January, where I was saying I've just got so many pre-approvals and no one's buying. And then I went on holidays in March.
Yeah, damn you.
And all of my clients bought.
Yeah, correct.
So it was like the first half of the last financial year the first half of the financial year, a lot of people were inquiring, but people weren't putting, I guess, the pen down, signing contracts. They were just sitting and waiting. And then once those rates, what you were saying, Bernadette, the rates paused after November. We thought we were going to have a February rate increase, but they did not. And people just went, go, go, go. Yeah. It's time. Because then when rates come down, everyone was saying the same thing to me. When rates come down, I can borrow more. The market's going to go in further. Yeah. And that was the sentiment. And that's still what's driving a lot of people now, even though there are talks of maybe a rate increase. One increase, that's not going to stop people anymore. We've had 13. People have come out of it with still money in their pockets, like a lot of investors, a lot of equity still in the system. Wages are now sort of coming up as well. there's a lot of confidence from a lot of buyers. So I'm seeing a lot of that activity.
Well said. And I think we also overlay stage 3 tax cuts. Yeah, it's a bit of a sugar hit and it's a few $1,000s, but that's just giving people a few extra dollars in their bank account to spend, potentially, probably not save, but spend. So if we reflect back, I mean, that's the answer to my next question, which is what has surprised you? So if we kind of break this out into, 2 parts, the lending side and the property side. So if we go into the lending side, what has surprised you, if anything, this last year?
What has surprised me from a lending point of view is, while we've seen rates increase to the level they are at right now, and we've seen borrowing power shrink as a result, lenders have actually come to help borrowers still be able to lend in these environments by really expanding their policies to allow for different types of income, different types of LVR strategies to apply so people can still buy. So that surprised me at how, I guess, flexible lenders have become with certain policies to capture more borrowers and really help more borrowers out.
Yeah, cool. Bernie, what surprised you?
Lending wise, I don't have any surprises actually, because I feel like lenders, they do move with the market. And I mean, they have their margins, right? Like they've got their targets they have to hit in terms of loans that they write. So you can see when a lender is falling short on their targets because they'll lower rates. They'll increase borrowing power. So for me, it's just those natural ebbs and flows for myself.
Same, spot on. Yeah, I think to Damien's point, when lenders came out saying something like the 1% buffer on refinances, we're like, I don't use the word innovation lightly because there's very little innovation in home lending, but I was like, that's a new policy that could help a lot of people, especially, all that talk around the fixed rate cliff, and even still got, we got clients that are coming off sub 2% fixed rates now. I was like, geez, mate, like that has been an absolute weapon of fixed rate that you had locked in. And naturally they're up for a bit of mortgage shock, but they'll adjust as everyone else has. And I think the 1% refi buffer has certainly showed that banks are here to play and here to lend. So that was a pretty good initiative. To your point, the only thing that probably surprises me is how much of an expert everyone is on inflation now as well. I think 18 months ago, no one gave a rat's about inflation. Now every person is an inflation expert, if you ask me.
Believe me, I'm quoting the unemployment figures every month when they come out in CD.
I didn't even know what CPI stood for until it was at 7%.
So I think that's and I think that's probably what everyone's keeping an eye out on. And the changes this year around how the RBA meets and what they give feedback. I think it's been a pretty good initiative as well. I've probably seen some change in the guard in the RBA and what happens from their comms. So that's a good one. When we talk about any new policies or changes in lending, I'll probably lead here by going, particularly for the investor side, we saw CBA, ANZ come back into this 95% LVR space in investor, which they haven't sat at. They've always sat at 90%. So to see them kind of nudge back in, we always say that once you see a big lender like CBA or ANZ make a play, then others typically follow suit or open their books up a little bit more as well. That's one. The other big one was the cashback. So it was highly controversial. I mean, we loved it. We hated it at the same time because it kind of just like dangles this carrot for switching. I don't mind the fact that banks cover some type of cost when you refinance and move your loan across. So I don't feel like that's the reason to switch. It was always a bit of a sugar hit when we looked at it, but it sparked some type of inquiry is how we've framed it. What do you think, guys?
Yeah, I think the cashback made refinancing easy for people.
As in, it made it easy to give them a reason, or made it easy to actually switch banks?
To give them a reason to switch banks. Yeah. So it made, the conversation really easy. Your rate's lower. You're going to get a cashback. Yep, you're going to be better off. When you've now got to factor in the fees to refinance into that interest saving that you'll get, it does make it a little bit more difficult to refinance people. And I think what you said, Aaron, is there maybe should be some type of incentive that a bank that you're going to should give you to cover your fees to refinance. If it's not the full $2,000 cashback, what the average refinancing fee is somewhere around $900 to $1,100. So maybe just the cashback to cover fees to refinance to make it a lot easier for people to switch banks. Because if you're saving, 10 basis points on the rate, it takes you 2 years to recoup your fees. Is it really worth refinancing?
Yeah.
So people do get stuck if they don't have that incentive. But from a bank's perspective, they were no margin. There was no margin on their deals. So I understand why they took it away.
Yeah. And when we talk margin, we always talk about players like Macquarie Bank. They, you send them like a pretty decent couple $1 million loan, and they won't even come to the party on lowering their rate because they're such a margin player that it's like they're staying true to their margins. We saw other lenders that, only this financial come 30 June 2024 is when they'll roll back their refinance offers. They're willing just to throw money at acquiring new customers to get their numbers up, which I know that you talk about a lot about, Bernie. Kind of just effectively hitting their targets and moving on. So what about you in your space? Because you do a lot self-employed SMSFs. What's going on in your space?
Yeah, I think some more generous policies for people who are self-employed. So particularly if you're newly self-employed. So in the past, your ABN has to have been registered for at least 18 months. There are now some lenders who will look at you if your ABN's been registered for 6 months and you've been paying yourself a consistent wage. And this is not a low doc loan. This is full doc loan with proper banks, paying standard normal fees and rates. So that's
awesome news for someone self-employed, newly self-employed.
Totally. And I speak to them all the time. Someone who's PAYG, perhaps they were a consultant in their field and then they realize they can actually go out and charge a little bit more by being self-employed. And then they come and speak to me. And previously it's been like, well, I need an ABN for 16 or 18 months, sorry. And now it's like, no, it's only 6 months. So also something to be mindful of if you are looking to go out and start your own gig, set up that ABN sooner rather than later as well, because that will help.
Yeah, big time. Yeah, that's great advice. Yeah, too many people wait to get that ABN registered. It's like you could just be sitting on that ABN that's technically registered, no trading on it.
Correct.
But at least it's registered in the system.
Correct.
Yeah. Yeah,
so if you look up like ABN lookup, if you look up any company name or the trading business, it has a register there of the company name and when the ABN and when the GST was registered. So that's how you can identify that.
Cool. So you're saying someone 6 months and then has been paying themselves
for 6 months.
For 6 months.
Yeah.
Got to be consistent.
Yep.
Okay, cool. Thank you. And then what about in the SMSF space? Because I know you've been doing an absolute bucket load of this stuff at the moment.
Yeah, SMSF is hot property right now. It's everyone looking to extend their borrowing power. So one of the policies, so everyone knows typically you can go to up to 80% for an SMSF property.
I've seen one at 90% as well.
There is, correct.
Yeah.
There are a couple of lenders. It is attached to quite a high risk fee though. So the risk fee for those 90% loans is anywhere from 2.5 to 3.5%.
2.5 on the loan amount?
Correct. Yeah. So it comes out pretty expensive if you do the sums, and some people that I've spoken to have said for them it's not worth it, but always worth doing your sums. So the other one that I've seen that I really like that is a little bit innovative is buying a property with 2 SMSFs as tenants in common. So if I could give everyone an example, Aaron and I have an SMSF and say we wanted to buy a property but we didn't have quite enough borrowing power. Well, I might have a chat to Damien, my brother, and his partner, and perhaps they have an SMSF. We could actually go out with our separate SMSFs and buy a property together, and we would be listed as tenants in common. So that's definitely something if you're probably looking more of a bigger sized property. Most people that I speak to can get a decent property, about 500, 600 in their SMSF. If you are looking to buy that bigger property, maybe look at pooling funds with another party that has a decent balance as well.
Yeah, I like it. Again, innovation and mortgages don't sometimes go hand in hand, but that's an awesome policy that it comes out, particularly for, like you're saying, commercial or larger size properties, and then where one self-managed super fund party doesn't have enough to complete. Join forces and away you go.
I'll just do a couple of disclaimers. You have to both be 50%. So, and both have the same loan amount. So Yeah, same loan amount, same contribution.
Cool. Speaking of disclaimers, just remember that this is not financial advice here, and please do seek out a professional. This chat is general in nature, so we should throw that there in the start. But nonetheless, it's still in there. Cool.
I've got a good one, Aaron.
Go for it.
Yeah, so I've got to verify this. I was speaking to the bank manager last week, but on the back of high interest rates, this certain bank isn't getting that many customers, so they've had to get a little bit more creative on their banking policies. And what he was telling me is they can go in and complete a refinance on a property. Say you bought a property with an 80% LVR. They can go in and refinance it, attach a guarantor property from a parent after the purchase, and allow you to cash out against that guarantor property.
Right.
So instead of having to, when you normally get a guarantor loan, it's there for the purchase. You purchase the property with the guarantor and that's it. You pay down the loan, the guarantor is released. They're saying they will allow the guarantor to come in at any point and you can cash out against it. So they will allow you to do that, cash out, and then go and buy an investment property.
That is awesome.
So I'll have to look into the T's and C's on this specific policy because it sounded too good to be true. And sometimes people will tell you policies that aren't in place just yet. But yeah, it was really eye-opening because I was like, wow, people can go and if they've got parents now looking to help them like grow their portfolio, this is the way they can do it.
Yeah. Oh, I mean, absolutely. I mean, the Bank of Mum and Dad continues to deliver in spades at the moment, doesn't it?
Yep.
Yeah. We see that time and time again. So I really feel, and I've had this chat a lot on the podcast, even probably in a lot of conversations with clients, we are probably on the precipice of this now becoming the haves and have-nots generation, if it's not already. So have and have-nots, wealth inequality through property. I mean, our kids are very, very small, 3 and 5 years old, but I feel like when I hear, let's say, for example, Trinity in our team and her brother's 18 or even some of her family members, there's no way that her younger brother at 18 years old is probably going to buy his way into this property market without any assistance from a family. Maybe you might be lucky to get a government scheme, lucky, but you'd almost bet that there'd be parental assistance to enable someone like that to get into the market, right?
Definitely. And it's not like it already is haves and have not in certain areas. Like if you're looking to buy anywhere in the eastern suburbs of Sydney and you want to buy a house, there's a very good chance that you need some type of parental support to get into that type of market.
Well, I mean, you put the two combinations, deposit and borrowing capacity together. You need to be on strong incomes. And if you're on those strong incomes, what are you doing not having on board already? And then if you're selling and upsizing, then you're competing with sharks that have strong borrowing capacity as well.
Exactly. And it's now moving towards all other markets. It's sort of, you need to have some type of support to get in or start really young. We were listening at a conference last week and, to start saving for a deposit, the 20% deposit takes 40 years to save, whatever they say. You don't need a 20% deposit, people, just FYI. But, people like to say that to you to make you feel even worse about your position.
I mean, I've heard this from a client the other day when she's like, my last broker said, don't ever get mortgage insurance. I was like, that mortgage broker needs an absolute uppercut. Why on earth would you say something like that? And then, to Damien's point, it takes on average 14 years to save on an average income to buy an average home. Like, we're talking about laws of averages here. There's some that are over and under that as well, right? It's insane.
No, I think so. Yeah, if your mortgage broker is telling you not to do something, well, we're not paid to give advice. So as soon as someone's telling you yes or no about a certain strategy, I would walk away from that person pretty quickly. And, what they were saying was, if you've got kids now, you need to start saving for the deposit from the day they're born. That's what you now need to do.
But then also when you think about it, I've been really challenged on savings because, I mean, the girls have some pretty good savings in their bank account, but over 10 years' time, it actually runs down like that call it $30,000 at the moment in 10 years' time isn't worth that because it's a diminishing value.
Yeah, so you need to invest it. Yeah, exactly right.
So saving isn't actually the answer sometimes. You need to actually have that money working for you to beat inflation and the market.
Yep. Because you can put it in a high interest savings account, 5.5%. At the moment, that is beating inflation. But historically speaking, when rates come back down, that rate will come back down as well in line with inflation.
Yeah.
And then your cash will either sit there not really growing, or you could have it invested in something that's 8-10% a year.
Or you could just park it in your offset account.
We absolutely could do that as well.
And save yourself 6.5% interest.
You absolutely could.
But, so sure, their balance isn't growing.
Yeah.
But you're saving, your household is saving that interest that you would have paid.
So
you pay off your home loan quicker.
So are our girls' accounts offsetting our mortgage?
100%.
Awesome. Okay, great. So they're effectively paying their rent, which I like. That's cool. I want to change tack just a little bit. Ask you both one question, or maybe it's a loaded question because I've got my answer to it. Is there a money personality, a money mentor, or a teacher, educator that you guys follow or resonate with on socials? And while you're thinking, I'll say mine. I've been big into Dave Ramsey. So if someone's not familiar with Dave Ramsey, awesome. It feels like a talk show where people call in, and I'm consistently blown away by the stories they get where people have some strong incomes and they've got these high levels of debt. There is one common element to these stories, and it's the reliance on car leases, car loans, and then credit cards is the next step. I'm blown away. Obviously, the American system is very different to ours, but the way that people can just get credit cards and then get more credit cards, then get more car loans, that's probably something that I think. When did I sell my car, Bernie? Do you reckon?
4 or 5 years ago.
Yeah, probably Sienna was born 5 years ago. Mm-hmm. So yeah, for those that aren't familiar, I had a brand new Golf GTI. You do the whole self-employed thing. I'm going to try and claim this and get the depreciation, all that other jazz. And then we had a car lease attached to it. And I'm like, what are we doing here? When it started to impact borrowing capacity.
Correction. I think I said, what are we doing here?
You said, what are we doing? And I said, yeah, I'm listening to you at this point because it's hurting our borrowing capacity. And I literally drove it into a dealership and walked out with a $20,000 check and a very small secondhand Mazda 3 with no finance on it. So I feel like I am qualified to give feedback to people when I see these expensive leases. I'm like, I've done it. I've done it. What's your excuse?
It's the ego, right? Like to go from a car that's flashy, all very nice to look at and have a secondhand, whatever you choose. That's definitely a hit to the ego, but it's ultimately long term. What is that? What are you optimizing for and what are we building for? And it's, if that's something that's like sings to you that you're like, actually, I think the thing that kills me is when I see someone that has like a $1,200 lease per month, and that is the deficit they would have an investment property. Mm. And I tell them, you need $1,200 plus expenses, whatever it to cost to hold the property, and they hold on to their car with such
fervor.
And I'm like, but mate, that is a depreciating liability.
Yeah, they put in the asset column.
They put it in the asset column.
It is depreciating liability.
Depreciating liability. If you sold it off, walked away, say a secondhand whatever, or even new something, but no finance, and then you could redirect that $1,200 a month to a appreciating asset.
Income producing, appreciating asset.
That's game changing stuff.
We can't say it. We can't say it enough. We can't say enough. And again, Bernie and I can say it because we come from one, a place of love, but two, a place of experience, saying we have done it ourselves. What are you doing? Like, why are you putting this money? Yes, it's a status symbol, like it's attached to a car, but wealth. And I think this is one thing that we did when we read The Psychology of Money. Rich is what people see. Wealth is what people don't see. So they see you being rich with your expensive car, but they don't see that you've got an investment property.
There's another really old book called The Millionaire Next Door, quite old, and it talks about how the millionaire next door is not the person or the family that has that mansion with the 2 European cars in the driveway. The millionaire is the one that's in the house that hasn't been renovated for 10 or 15 years, that's driving those secondhand cars, that from the outside you go, oh, they'd be like living a pretty modest lifestyle. But what you don't see is how smart they're being with their money. They're investing it. This perception of what we see, that's only one surface level. And I think if we can all take it down to that next level, and what don't you see? But sometimes also, don't get me wrong, someone with a beautiful mansion, the 2 European cars, they might also be investing very well as well. So there's no judgments there, but it's like, take away what you think success is and really you have to just look at your own bank accounts. It all starts there. And if I could jump onto your point, Aaron, I think I have invested heavily into reading, into money mentors, Dave Ramsey, The Millionaire Next Door, books that I've read. The Richest Man of Babylon was a game changer for us. Barefoot Investor, Tony Robbins, a lot of these books I've read, and I've taken little snippets from everyone and I've created my own system. And this is going to sound a bit righteous, but I'm actually going to say I'm my own money mentor at the moment.
Good one.
Because I'm really happy with how our household budget and our buckets, it's not a budget actually, it's how our buckets work. It's given me a confidence in our money that I've never had before. And it's something that I do want to teach others how to do as well. So
good one. Good one.
Yeah, I'm glad you spoke, Bernadette, because it reminded me of all the money mentors that I've had. I was sitting there for so long scratching my head trying to figure it out. Definitely, look, Dave Ramsey is so entertaining and he is so right. And whatever's going on in America is wild with their credit card and car, but it's very similar here in Australia. Because we see it, the car on lease, the credit card balances and limits. I need my points. I need my limits. I need my my car on lease. I've got a balloon. I'll trade it in 5 years and get a new lease. The forever lease, just always on a car lease. Never ever not being on one. That sounds so stressful to me, to be very honest. I think it's stressful enough getting my car registered once a year. $1,000 on insurance and rego. Imagine that every month.
Yeah.
On top of that as well. So yeah, I love Dave Ramsey. And then Bernadette mentioned, Scott Pape, Barefoot Investor. He probably was that first one that switched it in my mind. It's just a great book. If you don't know anything about finances, you've never done a budget, you've never done anything, you've just lived your life, and then you've gotten to a point where you go, what's happening with money? How does it all work? That's a great place to start because he breaks it down very simply. A couple of untruths, sure, in that book, but a lot of the basic budgeting is really, really spot on. And Bernadette uses the terms like bucketing, that's all from that book. Yeah, it's a wonderful book and a wonderful place to start.
Yeah, well said. I like it. It's exactly it. It's probably the best place to start. And I think as your maturity and you start to grow in your portfolio, you then start to pick out people that go down the path of investing through flips. They find their gem. People that want to go developing or people that go cash flow, they'll find their quasi mentor, for example, people that have been there, done that, and some guests that we've had previously in the podcast absolutely kill it as well with their philosophy too. So if you do need some guidance, feel free to reach out to us soon. We've got plenty of resources. We've got plenty of books from authors that have been on the show. We've got books that we've personally read as well. Happy to share the knowledge, and that's what we're about here. So just a quick one, looking ahead, the next 12 months is far too hard to predict. But if you look to the end of 31 December and say, where are we? Where do you think we'll be, Damien? I think from a property market. Yep, I think we're just going to continue on this road. I was very surprised at the start of this year as the market strengthened. And the media narrative again is saying, like Sydney, for example, 8%, 8 to 10% they're predicting again. Like it's just turned that quickly. And a lot of people believe it. It's now June. I've got 3 contracts hit my door on Monday this week. I think we had like 250 auctions on the weekend in Sydney, and I've got 3 people in Sydney looking to buy. So there's a lot of activity still happening in winter when we normally have no activity or it's a lot slower. I don't think we're seeing that on our end at the moment. And I'm not concerned, but it's going to be pretty interesting to see what happens come this spring auction season because we didn't really have it last year again. It was a bit of a flat market in September, but the market is really, really strong. It seems to be growing and growing. So I probably see the momentum continue until the end of the year. And I really think we're going to have a pretty crazy spring. I do think that. Nice one.
Yeah, I echo that. I think for the investors out there, when I was speaking to a lot of them at the beginning of the year, we were still looking at getting pre-approved to buy a property at 400. I think that price point is quickly disappearing.
We'll say that's exactly my point. Yep, keep going.
So a lot of those investors, they were looking regional Queensland, think your Mackays, Townsvilles, those sorts of areas. There are still opportunities there, but the demand for them, it's just absolutely bananas. So people who were pre-approved at the beginning of the year for that 400,000 purchase, they are coming back to me saying, Bernie, it's not enough. I need a little bit more. So I need closer to 450, 500, even 550. I had another contact tell me they probably think Perth can't get anything below 600 now, which, you know, going back 2-3 years ago for Perth, I don't think anyone would have believed you. So, yeah, really seeing that growth in those markets just because the demand is there from investors and locals as well, obviously, who live there as well. So that's property-wise. Rate-wise, I am really putting it out there for a rate cut in September. I could be totally optimistic.
Is this a personal agenda that you have? Yeah, okay, yeah.
100%. But I would love to see one September, one rate cut September, October, November. I think just to give it a little bit of that ease. Definitely have been speaking with a few business owners over the last week and a bit, and the business owners really are commenting about conditions being challenging, challenging from a staff point of view, from team, from clients' expectations, and just to deliver. And I think a little bit of some financial ease would help a lot of these situations.
Yeah, someone burst your bubble there. I don't think it's coming personally. I didn't ask you, Damien. Yeah, I'm going to try and let you down gently there.
Strap in.
Yeah, I think maybe early next year's a rate cut. I mean, there was one wild. Who was it? The guy at Judo Bank, the economist, was like 3 rate rises this year. It was something along those lines. I was like, that's a bit wild. I don't know. I think it's more a wait and see approach personally from everything I'm reading and hearing. It could be that way, and it'll take something. Here's the thing: we're getting a stage 3 tax cut, so they're like, there's the bit of relief that people may be looking for across the board. Yeah, so mate.
Yeah, it's like businesses are doing it tough.
Oh, mate, look around. I mean, they're saying now that for the first time they're seeing coffee consumption start to decline. Amazing. So people are now cutting back the one thing that they thought was non-negotiable. Yeah.
I'm on the teas, but it's for a different reason. Reflux.
the mushroom, mate.
But it's, and I mean, I've been just looking around, like you go Westfields, you go everywhere.
Yep.
Everything is for sale. Retail is hurting right now. I don't know if you guys have seen it.
Oh, I see it all the time.
50% off here. Every shop has a sale, whether it's a small business to a fairly big franchise. Everything is for sale. So that sector is really hurting.
My Persian carpet rug's closing down finally, maybe. I don't know. It's been closed down for the last 20 years. I think they've been doing it tough.
And I do hope we see a rate cut at some point this year. I'm with Aaron, but I do not see it happening. You know, two of the biggest drivers of inflation are rent, and I think it's like electricity prices.
Right.
You know, they have no correlation to interest rates. So,
well, rent does in a way.
Rent does in a way, but that's more of a supply. I guess it's a combination of the two, right? I mean, landlords can pass on their rate increases to their tenants, but tenants can also move if it gets too high. So there is something stopping that happening. But yeah, I don't know. I don't see rates coming down because I think those two things will keep inflation quite high.
Yeah.
And they won't drop rates until inflation is down. So even though rates don't really impact rents or electricity that much, I mean, I think the impact's already been done on rents with rates. I don't see rates coming down from the RBA because cutting rates probably just fuels another sort of sector of the inflation equation, and it'll be sticky and around for longer. But fingers crossed.
Fingers crossed.
A mortgage too.
Well, yeah, you do. Yeah, sure, you have a mortgage. So watch this space. Let's do a wrap. We'll do another wrap. Obviously, we'll keep doing our Q&As, but we'll do an end of year wrap and see how our predictions have panned out. I want you to be right, Bernie. We all want you to be right. Yeah, correct. Hey, everyone. We're loving the feedback. Like I say, we love when we get people that are listening, reaching out to us. I say we're not doing this for any, like the commercial side of it. for inquiries. What we're saying is when people reach out saying, I love that episode, it's a really good feedback loop that the stuff that we're putting out there resonates with you. So if this episode has hit the spot, and also if it gives you a chance to reflect back on your own personal financial year, end of mid-year from a calendar perspective is a really good time to take stock. And I'm telling people now, if your aspiration was to buy an investment property, we're halfway through the year, you can still take action. You think about it, it's going to take you a few weeks to get pre-approved and organized and find a property. You got to plan that in the time frame. So if it's an aspiration you have for this year, 2024, that's when you should be reaching out and trying to get yourself into the driver's seat to take some action and get into this property market, because it is happening with or without you, right? Cool. That's a wrap for another episode of the Australian Property Investment Podcast. We'll talk to you soon.